It's time now for our weekly Muni moment. We're going to resume our discussion on central banks' inflation and rate volatility, and we welcome right now Chip Hughey. He is Managing Director of Fixed Income at Truist. Chip, good to speak with you. Give us your outlook for Munis in the second half, because positioning in equities has turned more bullish as stocks entered a bull market, and we heard from Jay Powell today making clear that he sees the possibility of more interest rate increases to fend off inflation. Where does that leave allocation to fixed income and specifically to Munis?
Yeah, Scarlet, Romaine, thank you so much for having me. I appreciate it. So we're constructive on municipal bonds in the second half of 2023. Largely, that's driven by our expectation that we are at or very close to peak yields currently. So not only are municipal yields really productive, and it should stay that way with the Fed likely holding rates higher for longer, but that will also contribute to the income, going forward as well. And then there will be the benefit that if U.S. Treasury yields do fall, municipal bonds would benefit there as well.
What does that mean for supply, Chip?
So I think that as we get towards the end of the Fed hiking cycle, some of the certainty around what the Fed might do going forward, that might be very helpful to get issuers back into the market. We've got a really low amount of supply relative to history. We're down about 17% year to date versus this time last year. So supply is low, but demand is very strong. And we're entering a period, June and July is historically a time where we see really strong reinvestment demand. So we have about $37 billion expected in reinvestment demand over the next couple of months, with about $10 billion expected in new supply. So we do need to see healthier supply come to meet that demand that we're expecting.
Well, one reason why I'm curious about new issuance here, Chip, too, is the idea of competition, right? I mean, we come out of what had been a historically low interest rate period. There was only one place to be for the most part, and that was in stocks. And then, of course, the last couple of years, we've seen fixed income and particularly munis really shine. But that differential, that benefit that munis had over other assets seems to be closing, even other fixed income assets.
That's right. A lot of that's supply that's driving that. We've got the ratio or the yield in municipals relative to U.S. Treasuries is historically low, and that's especially true in the first 10 years of the curve or so. So that is something that is a challenge for municipals, and a lot of that is because there is still really healthy demand amidst very light supply. So that's not to say, though, that we got to also take note of the fact that municipal yields are still historically high. That's very true in the front end of the curve. And so from a historical perspective over the past decade or two, they're still very attractive and productive as well. But on a relative basis, healthier supply would help.
Speaking of supply, a bunch of elite private colleges have been tapping the muni bond market. Thinking about Swarthmore selling, $125 million of debt, BU borrowing $224 million, Yale, a $112 million issue, Columbia, $275 million. Is demand for their debt as strong as demand for admission to those schools?
Yes, I think that what you're seeing at these flagship universities, that there's still really large growth plans, and those have to be supported by debt. And some of those issuances that we're seeing have been delayed through the uncertainty of 2022. We're getting a little bit more stability, less volatility in rates. That's helpful to bring some issuance, but it's not surprising to see these large colleges that are still growing to issue debt. One thing that we would say, though, is as we evaluate university issuance, we think that right now is a time to keep municipal bond purchases up in quality. So we would favor areas like large flagship universities, and the more speculative or very small private schools, we would be a little bit more careful on.
Yeah, I mean, those are schools that everyone is trying to get into. I'm curious about the funding needs that these schools have, because as the admission rates have gone down and the tuition has gone up, they are all in this arms race to increase their infrastructure. And that has also pulled in some of the smaller, less elite schools that are also seeking funding.
That's right. I think if learning habits have changed, then colleges are looking for ways to attract students to continue to apply to those colleges, and sometimes that is infrastructure improvements, better facilities, et cetera. So they go to the municipal market to help meet those. That is true, though, in this race to continue to attract new students that could pull in more speculative issuers in the university space. So to that end, we would be careful now, because we do expect to see slower economic activity as we move through the rest of this year, and therefore that supports the notion of really focusing on higher quality issuers.